Hello guys, welcome to the channel Accountingology with Faisal Shah, and in this video we'll discuss about the main 5 pillars of accounting. So to begin with, I would like to tell you a small word which is LCR that describes all 5 pillars of accounting. In this, A stands for assets, L stands for liabilities, C stands for capital, E stands for expenses, and R stands for revenues. So the word LCR represents all 5 pillars of accounting, which includes the assets, liabilities, capital, expenses, and revenues. So to begin with, we'll discuss first about assets. So what are assets? Basically, they are the resources of business, whether owed or owned by the business. They are the possessions of the business. They remain with the business for more than one financial year or within one financial year. They are divided into two categories, which is current assets and non-current assets. So here on the screen, you can see the two types of assets, that are the non-current assets and the current assets. So first of all, what are non-current assets? They are the assets used for more than one accounting period or the financial year. This means that the business buys these assets to use in the business for more than one accounting period. For example, machines, vehicles, factories, and many more. This type of assets, that is the non-current assets, are also known as fixed assets because they remain fixed with the business for more than one financial year. Whereas the current assets are a little bit different. They are the assets used within an accounting period. That means the business buys these assets and use all the current assets in one financial year. For example, inventory, receivables, and cash. That means these assets remain with the business for only one financial year or within one financial year, not more than that. And the thing which makes them different from non-current assets is that they change their form continuously. So basically, the difference between non-current assets and the current assets is that current assets remain in the business for more than one financial year, whereas the current assets remain in the business for less than one financial year. So now let's move on to some examples of current assets. They include inventory, goods, receivables, and cash equivalents. Now the inventory is the stock of goods bought or produced for resale. Then what are goods? Goods are the items in which a business trades. The receivables are the people or business to whom we have given credit. It includes trade receivables and general receivables. The general receivables also include the prepaid expenses. That means the expenses which we have already paid for but haven't availed yet. And the cash and cash equivalents include the cash or bank. That means the cash in hand or the cash at bank. So let's move on to the next pillar of accounting, that is liabilities. So what are liabilities and what does the term describes about it? They are the resources owed by the business. They are the obligations to be repaid. Liabilities are divided into two types, that are non-current liabilities and the current liabilities. So basically, the liabilities are the resources that are owed by the business, that is owed by us, and they have obligations to be repaid. That means the business has to pay all the liabilities back to the people who the business owes. Similarly, like the assets, the liabilities are also divided into two categories, that are the non-current liabilities and the current liabilities. Here on the screen, you can see the two types of liabilities. The first one is non-current liabilities and the second one is current liabilities. First of all, the non-current liabilities are the long-term obligations like long-term loans and debentures. They are basically the long-term loans which the business has to repay in more than one accounting period. That means the time given to pay these loans is more than 1 year. The business can repay these loans back after 1 year or after more than 1 year. The examples include debentures or loans, which are long-term loans. Whereas the current liabilities are the short-term obligations like payables, bank overdraft, or short-term loans. They are basically the loans or the amounts due which the business has to pay within an accounting period. That means the business has to repay all the money to the payables, to the bank overdraft, or to the short-term loans as soon as possible. And they are known as current liabilities because the business has to pay the amount within one financial year. The examples in this include the trade payables, bank overdraft, and the short-term loans. Now let's move on to the third pillar of accounting, that is the capital. So what is capital? They are the resources owned by the business, investments of the owner, and determining the ownership. So capital is the money, that is the investment of the owner. The investment, the amount which is invested into the business by the owner is capital. It also determines the ownership, which means the more you invest, the more you can own. That means the more you invest the money, the more decisions can be made by you. So the capital has two roles, the two main roles or two main characteristics. That is, the first one is investments of the owner. That means the money which is invested by the owner or anything that is invested by the owner into the business is capital. And secondly, it determines the ownership of the business. The more the capital is invested by the owner, the more he gets the ownership. The fourth pillar of accounting. So this is the fourth pillar of accounting, which is expenses. You all might know the term expenses and you might know the definition too, but still, when it comes to accounting, we still have to see the definition of expenses to determine whether they are capital or revenue expenditure. So expenses are day-to-day running costs like rent, utility bills, wages, and many other small expenses paid by the business to earn revenue. Similar to the assets and the liabilities, expenses too are divided into two categories, that is the capital expenditure and the revenue expenditure. Now it is important to see for the capital and revenue expenditure because when it comes to prepare income statement, so we have to determine whether it's a capital expenditure or the revenue expenditure, because the capital expenditure goes into the setting cost of the asset, and that is, it is included in the cost of production, whereas the revenue expenditure goes into the expenses side of the income statement and it does not include in the cost of production. So the revenue expenditure determines the profit, whereas the capital expenditure determines the gross profit. So it is important to create distinction between capital expenditure and revenue expenditure because this can either overstate or understate our profits. So it is very important for an accountant to see whether the expenditure made is capital or revenue. And the last of the pillars is revenues. The term revenue is described by the earnings or incomes of the business. The difference between the revenues and profits is the expenses. The revenues is the difference between the revenues and the profits. The equation can be made profits is equals to revenues minus expenses. The revenues are divided into capital income and revenue income, same as the revenue expenditure and capital expenditure. It's important to create distinction between the word revenue and the profits because the word revenues is the total amount we receive after making our total sales. However, profits is the amount we get after deducting the expenses from the revenue. The equation hence is profits is equals to revenues minus expenses. Now the revenues too are divided into two categories, that are capital income and revenue income. The capital income is the income which we make from selling our non-current assets, that is, if a business sells its cars or any other non-current assets, so it receives cash or check in return. So the check and cash is the capital income for the business, whereas the revenue income is the income made by making total sales. If the business sells its goods produced, it will receive the revenue, that is the revenue income for the business. In conclusion, students, these are the 5 pillars of accounting, which is LCUR, the assets, liabilities, capital, expenses and revenues. They are the 5 pillars which you need to remember. These are the 5 pillars that are covering whole of your accounting syllabus, and they are in each and everything you do, in each and every chapter and in each and every method or any income statement or financial position. You need to remember the 5 pillars of accounting, and you should know what is the definition and what are the examples in each of these 5 pillars. So moving on to the end of this video, students, you are advised to go through the video again and make notes of all these 5 pillars and write any 2 examples with each of the 5 pillars and write 2-line definition so that you know what are the 5 pillars, you memorize them thoroughly, and that if someone asks you what are the 5 pillars of accounts, you should know each and everyone's definition and 2 examples. So students, if you found my video interesting, so like the video and subscribe to channel Accountingology with Faisal Shah to stay updated with the latest lectures and this kind of interesting videos. Thank you for watching.